Having $50,000 or more in your bank account might feel like winning at life. Safe, secure, untouchable. But what if I told you that keeping just this amount in one place could actually be costing you thousands every year? Your money could be losing value without you noticing. Inflation, missed investment opportunities, and even scams are quietly chipping away at it. The shocking part is most people don't even realize the exact point where their safe balance stops being safe. And once you see that number, it might completely change how you think about your money. You know that good feeling when you check your bank account and think, "Nice, my savings are safe?" Well, here's the part most people don't realize. Even when your balance looks the same or grows a little, what your money can actually buy slowly goes down. That quiet thief is called inflation. Let's keep this super simple. Say you have $10,000 in your savings account. Your bank gives you 3% interest a year. So after a year, you'll have $10,300. Sounds good, right? But if prices go up by 8% in that same year, something that cost $10,000 before will now cost $10,800. Even though your balance grew, it can now buy less. In real terms, you actually lost $500 of value. This isn't just a random example. In the United States, inflation was around 2.9% in 2025. But many savings accounts pay less than 1% interest. That means even though your account grows a bit, the real value of your money is going down. It's like trying to fill a bucket with water while there's a small hole at the bottom. You pour in a little, but some quietly leaks out. If you keep your money in the bank for many years like this, the effect builds up. 10 years later, the number in your account may be bigger, but it won't buy what it used to. That's why simply saving isn't always enough. If inflation is higher than your bank's interest rate, your money is slowly shrinking while you sleep. It doesn't make a sound. You just wake up one day and realize things got more expensive and your dollars don't stretch as far as they used to. Another thing many people don't think about when leaving large amounts of cash in the bank is the risk if something goes wrong with the bank itself. Most banks protect your money, but only up to a certain limit. In the United States, for example, the Federal Deposit Insurance Corporation, or FDIC, insures deposits up to $250,000 per depositor, per bank. That means if your bank suddenly failed, the government would guarantee your money only up to that amount. Anything beyond it may not be protected. While bank failures are rare, they do happen. History has shown that even strong banks can face trouble during financial crises. If you had more than the insured amount in one account and the bank collapsed, the extra money might be at risk or take a long time to recover. This is why experts call it concentration risk. Think of it like this: if you put all your eggs in one basket and that basket drops, you lose everything at once. The same idea applies to keeping too much money in a single bank account. Splitting your cash across different banks or financial institutions can reduce that risk. This doesn't mean you should panic or empty your account. It simply means being smart and understanding where your money is safe and where it could be exposed. For most people, keeping cash below the insured limit and spreading out larger amounts is a safer strategy. It's about protecting not just what you've earned, but also what you could lose if you're not careful. Here's another hidden problem people don't usually think about. When you see a big number sitting in your bank account, it can play tricks on your mind. It makes you feel richer than you actually are. You start telling yourself it's okay to spend a little here and there because there's plenty left. And before you realize it, that safe cushion starts to shrink. This isn't about being reckless, it's just human nature. When something looks abundant, people tend to loosen up. It's like opening the fridge and seeing it full. You start snacking even when you're not hungry. There's a story of a man who saved $40,000 over the years. He felt proud seeing it in his account. Then came a few small treats, a weekend trip, a new phone, a fancy dinner. None of these felt like a big deal at the time. But years later, that $40,000 was down to $12,000 without any major purchase. It was the slow, quiet spending that ate it up. That's the trap. A large idle balance can make your brain think it's free money. It blurs the line between what you should save and what you can spend. And when that happens, big dreams like buying a house, starting a business, or investing for the future start to slip away. The best way to avoid this is to give your money a purpose. Separate what's for emergencies, what's for investing, and what's for spending. When your savings are structured, you're less likely to fall into this psychological trap. It's about protecting your future from quiet, everyday temptations. Another smart money move that often gets ignored is understanding how much cash should actually stay liquid. Liquidity basically means how easily and quickly you can access your money. A lot of people keep way more in their checking or savings account than they really need, thinking it's the safest option. But in reality, not all your money has to sit there doing nothing. A better approach is to break your money into different buckets based on time and purpose. The first bucket is your emergency fund. This should cover 3 to 6 months of essential expenses. It's your quick access cash for real emergencies like job loss, medical bills, or sudden repairs. It needs to be liquid so you can use it immediately when life throws a curveball. The second bucket is for short to medium-term goals. That could be saving for a vacation, a car, a down payment on a house, or any plan within the next 2 to 5 years. This money can be placed in low-risk options that give you better returns than a basic savings account, but still let you access it without too much hassle. The third bucket is your long-term money. This is the part you don't need right away. It can be invested in things like index funds, real estate, or other assets that grow over time. Historically, the stock market has delivered around 7 to 10% annual returns over the long run, which is far higher than what banks usually offer. By splitting your cash this way, your emergency money stays safe and ready, while the rest of your money is working and growing. It's about finding the right balance between safety and growth, instead of letting everything sit idle in one place. That's how people build wealth over time. Keeping a large amount of cash in one account might look safe on the surface, but it quietly attracts another kind of danger: scams and fraud. The bigger your balance, the more interesting you become to people who make a living tricking others out of their money. And the scary part is, they don't need to break into your bank to get it. Many scams start with a simple message, a fake call, or a well-crafted email. According to the Federal Trade Commission, Americans lost more than $10 billion to fraud in 2024, with phishing and impersonation scams leading the list. Criminals use psychology to create panic, like pretending your account is at risk or offering fake investment opportunities. When you react quickly, they win. And the richer your account looks, the harder they try. The risk isn't just digital. In countries with volatile economies like Pakistan, sudden policy changes, currency devaluation, or withdrawal limits can reduce the real value of your deposits. Inflation already eats away at savings, but when governments tighten controls or banks face stress, getting your money out can become a challenge. People have faced long delays, restrictions, and even frozen accounts in times of financial turbulence. There's also a less obvious problem. When banks receive too much excess liquidity at once, it can actually strain their stability. So parking a large sum in one bank isn't as secure as many assume. Let's bring this all together. Keeping your entire savings in a bank account might seem like the safest option, but as we've seen, it slowly chips away at your wealth. Inflation quietly lowers the value of your money. Deposit insurance only protects a limited amount. A big balance can trick your mind into spending more. Holding too much cash keeps your money idle when it could be working for you. And on top of all that, it can even make you a bigger target for scams. The smarter move isn't to avoid banks entirely, but to use them wisely. Keep just enough cash for your emergency fund and short-term needs. Move the rest into investments or savings vehicles that actually grow your wealth over time. Spread your funds, stay aware of your coverage limits, and don't let psychological traps or scammers take advantage of you. Money should give you freedom, not sit in an account losing value. Building real financial security is about being intentional. Every dollar should have a purpose, whether it's protection, growth, or future goals. If you found this breakdown helpful, make sure to hit that subscribe button. This channel is all about real, practical money tips that help you build wealth and protect what you've earned. Your future self will thank you for learning this now, not later. This is MindCraft, where ideas become action, and action becomes your future.